Welcome to MGAA Conversations, our new podcast channel where we'll be discussing with an exciting number of guests all things related and topical within the ever-growing MGA community. Welcome to the latest episode of MGAA Conversations. Today, I'm absolutely delighted to welcome Chris Davies, Group Chief Executive Officer at DRS Bond Management. Chris, a very good afternoon to you.
Mike, it's a pleasure to join you. Thank you very much for having me on.
Okay, so let's get straight into it for our sort of growing number of listeners. So, Chris, please describe the DRS Bonds MGA business and how your market operates, because it is very niche, and I'm sure it'll be quite educational for our listeners to this podcast.
Okay, let's go for the elevator pitch. DRS Bonds MGA is born out of DRS Bond Management, as you've alluded to, which is a specialist surety bond broker operating throughout the United Kingdom. And the intention of DRS Bond MGA is to fill a gap that has developed in terms of capacity provision for SME, mainly construction and real estate companies up to 250 million turnover. So the idea is to introduce 2, possibly 3 capacity providers into that space over the coming 12 months to fill that gap and make the market whole again.
And when you've done that sort of target market assessment, Chris, and obviously through sort of your experience, do you feel that particular area does require that sort of, obviously you wouldn't be doing it if it didn't require sort of you guys to sort of enter that? You just feel you can bring sort of USP and other additional value to that particular sector?
Yeah, I think the critical thing is we're only going to deal with investment grade providers, which is kind of an absolute bare minimum now for most employers when they're coming to look at surety bonds. Surety is a bit of an oddball, which suits me fine because I am too, in that it's not insurance, as you know, so it's not subject to insurance premium tax. And theoretically, there's no risk transfer. But of course, in reality, if the contractor becomes insolvent, then there is risk transfer because the surety then comes in and picks up and cleans up behind them on their behalf. But it's quite a niche area. There's probably between a dozen and 20 specialists operating in this sector. Some of them use markets we wouldn't use that are offshore and unlicensed, unregulated, which is not DRS. But there's 2,500 general insurance brokers out there. Some of those need 1 bond a year, some of them need 10 or more. And the idea is to make sure they've got the capacity they need to service their clients' requirements.
Yeah. And just one final thing around the market, Chris, how sort of impact does the economic landscape have on the surety sort of stroke bond market?
Yeah, it has an appreciable effect. I mean, the 2 driving factors that led to capacity shrinkage in the first place were COVID and Ukraine. Both have taken their toll, particularly for the construction industry, where you've got a lot of contractors that bid work on fixed price lump sum contracts that then got hammered by inflation that arose particularly out of the Ukraine war. And therefore, this capacity shrinkage has led to, doesn't matter how many times you slice and dice it, contractors not being able to get the bonding that they need, never mind the bonding that they want. So we sort of, about 12 months ago, began to sketch out an idea of how we could fill that. And what became clear to us was partners that, in terms of capacity providers, that think long term, because potentially sure got a 3 to 5 year tail on each bond that's issued, or up to certainly. And therefore, there's a need for someone who doesn't get spooked if there's a downturn in the economy and indeed in the market. In the short term ahead, the Labour government has said they're going to build 1.5 million new houses. I'm not sure they're going to get to quite that level, but it's certainly a shot in the arm that's needed in the house building sector. That helps the construction industry and indeed property developers. And likewise, the government is pouring tens of billions potentially of new money into infrastructure, which is the other area that commonly does need bonds. So from our perspective, over the next 12, 18 months, the horizon looks relatively golden. I'm always a slightly cautious Kevin about these things because there are headwinds as well, but it does look relatively plain sailing so long as everybody executes on what they're here to do.
And what just again for the benefit, because it is such a niche area and obviously you've got your expertise, and those headwinds, in terms of, is that sort of a pool of government sort of funding, a sort of lack of sort of going forward with their commitments in terms of the projects and infrastructure you've just articulated?
Yeah, the political climate in the UK at the moment is quite febrile, as you would know, and that is a source of concern. Were there to be, for whatever reason, a change of chancellor, a change of prime minister, I don't see a change of government, but I can see either of those being a unlikely but high risk event were they to take place. There is certainly the rebellion last week over reforms to the welfare and benefits system. Are the sort of things that, even with 170 odd seat majority, can unnerve a prime minister and make them wonder whether or not they're actually in this for the right reasons, and maybe it's trying to give somebody else a go. So what we're assuming is that if you like, both Starmer and the Chancellor remain in post for the foreseeable future. Therefore, we've got some visibility around what their medium-term plans are. And on that basis, I think the industry and inward investors can look with a degree of confidence at the UK. But there's no question about it, whether it's Trump and the tariffs, whether it's the European Union and any sort of disagreements there, or whether it's more local to home in terms of the United Kingdom itself. Things are a little bit uncertain at the moment, and uncertainty always breeds, a sort of rowing back of investment just at the time where we really do need that to come through. So I'm hopeful that we now have a period of political stability as opposed to the opposite, and that the second year of this administration is a little bit more settled than the first year.
Yeah, so I think that's a very good point. It's a bit about holding the nerve at the end of the day, isn't it? So and try and keep some of the noise outside, and just sort of make sure that you stick to your guns and sort of navigate that path. Very, very interesting. Thanks for that, Chris. I want to turn to now, if I may, I want to turn to regulation now.
Okay.
So we're responding on behalf of our members to the recent Simplifying Insurance consultation, which does have sort of potential impacts on the MGA community and the sector. Just a couple of sort of themes for you, Chris. So one, I'd be interested in your overview around proportionality from a regulatory perspective, and probably secondly, anything in particular around that consultation or anything you feel the regulator should perhaps be concentrating slightly more on priority to sort of deliver more proportionality.
Okay, I mean, in terms of DRS bond management and its regulation, which obviously DRS bond MGA slides into, we are very lightly regulated. Whether that's a good thing or a bad thing is open to debate, but I'm not sure the FCA really even understand what it is we do. As I say, we are a niche sector, I understand that. But my concern is always, if you like, audit success. So where you've got people that are outliers in a particular sector, question, does the FCA look closely enough at them? Now, moving into the MGA space for us is obviously a step up. And I would expect, and indeed almost demand, greater probity from the FCA of what DRS is up to. Rest assured that internally we have very robust systems in place. My fellow CEO, Fiona Recker, is a former PLC company secretary and compliance director. So this is a space that we're very, very comfortable in, and we expect people to look at us through, plain lenses, but without any fog in them. We will always be very transparent, and I would like to think that as an industry, I'm sure if you look hard enough, you'll always find the odd bad apple. But I think as an industry, that we perform to the standards required.
Yeah, I suppose that when the sector looks outwards to the regulator, and we, as you know, we as members, valued members, we've had this, and we have this continued debate with Matt and his team. There's one element which says that should the MGA community be separately supervised, and we spoke to Matt about that. And to be fair to Matt, he's got, I believe, if these numbers are right, I think he's got 150 staff maybe and 8,000 firms to sort of regulate. So that's a challenge in terms of bandwidth overall. But what he has done, which we have welcomed, is that he has highlighted any areas which he believes the current sort of regulation doesn't apply to MGAs, because we're treated, MGAs are treated like intermediaries and brokers. Then to highlight that, and he'll look at that. So I suppose as come back to your point, as DRS Bond sort of MGA comes sort of to its fore, the key opportunity there is to highlight areas from that regulatory space. We'll say, well, this doesn't really apply to MGAs, and we can collectively go and go back to Matt to try and improve that proportionality.
Yeah, I'd be more than happy to contribute to that for you in as appropriate. My own view in terms of our niche, as I say, in terms of surety, is we are probably, can you ever be too lightly regulated? But we're certainly not heavily regulated, which again, I think comes down to a basic lack of understanding. However, when you put it in the context of regulated firms, we are a de minimis risk in terms of market contagion, whereas there are others that clearly, would be further higher up the profile tree. Sure. But look, in terms of where it sits, I think the regulator is doing an acceptable job in very difficult circumstances.
Yeah, that's fair enough. That's fair. Okay, let me pivot again. So, you would have been quite close to this as well. You would have seen it. So a lot of market discussion around attracting and retaining sort of both new and existing young talent into our sector. Yeah. Again, Chris, how do you think the sector's performing? What improvements should we be making to attract sort of the next generation into the exciting world of insurance?
It's interesting you say that. One of the biggest issues, in fact, I would say the single biggest issue across the industry is the talent gap between the ages of 30 and 49. We seem to be very good at attracting people from school, from university, but there is an awfully high attrition rate. And by the time you've got into those sort of, if you like, core hard-working, hard-earning years, before people hit 50 and start to theoretically make a lot of money, or sadly sometimes they go the other way. But those core earning years between 30 and 49, there is an absolute dearth of talent there. And I scratch my head. And from our point of view as a business, we are competing for talent. And the way that we compete for talent, you have to pay for it. I think there's an issue that perhaps needs to be articulated moreover, which is that in a post-Brexit world, it's not easy to attract folks from outside the United Kingdom to come here and be part of the insurance and financial services space. So therefore, you've got to look at homegrown talent. And do I think we've done enough over the years as UK PLC to prepare people for the world of business? I don't. So I don't think it just lies within the industry. I think it's a much wider problem than that. But what can the industry do to attract people? Fundamentally, without wishing to sound inflationary in any way, I think we've got to pay them properly. I think there are a number of sectors of our marketplace where salaries have barely moved since I entered the industry in 1987, which is, as you know, a lifetime ago. And that concerns me, because the dynamism that we need won't be there if we can't attract the talent. And the talent, if they don't come to us, they're going to go to other sectors of the economy. Yeah. And, not everybody can work in AI. Not everybody can be a YouTuber and an influencer. We desperately need good people. And the last 10 years in particular, that skills gap between the ages of 30 and 49 is getting wider and wider. And it is, I can guarantee you, around C-suite level, that is the biggest burning single issue that we all face. And we're fighting at the moment for an ever-reducing pool of talent.
Yeah, and do you think that pool of talent, coming back to your point, do you think that sector of talent is probably well remunerated across a planet, and therefore very difficult to sort of, let's say, unsettle, for want of a better phrase, or to lift into other areas, or do you, how do you see that particular age demographic which you've referenced in terms of their behaviours?
In our particular marketplace, I'll talk about things generally, but in our particular marketplace, people are moving and move quite freely, particularly at carrier level. Broker-wise, they tend to be more sticky, whether it's because brokers' remuneration is more commensurate, I'm not quite sure. But there is certainly a lot of movement in the underwriting fraternity. And talking to folks that I know on the insurance side of the fence, that also seems to be the case. apart from when teams are maybe lifted from one broker to another, the broker market seems to be more stable. But the underwriting side of things is very unsettled. And it's difficult to persuade folks to stay in post more than 3 years without them moving on, putting an extra nought on their salary and going elsewhere.
Yeah, I don't disagree with that at all. I was with a couple of our sort of insurer member CEOs recently, and they feel there's this talent war is starting to come back and bite, because they felt that when people were chasing underwriting talent and salaries started increasing, there was certain, I don't know the individuals, but there was a certain layer of individuals who managed to negotiate significant pay increases, which perhaps wasn't commensurate with their underwriting capability at that time. And I think as the general market, Chris, is moving into a sort of reducing rate adequacy across most lines, which you would be aware of, that's going to put some pressure around the expense ratio. So there could be some challenges over the next 18 months in terms of the dynamics if they start to emerge.
No, that's absolutely bang on. I think we're in danger of doing what a lot of the football clubs seem to be doing at the moment. And Chelsea would be a fine example of this, where they're recruiting kids that are in their early 20s in the hope that they develop and that their talent comes through. And they're paying a lot of money for it. And some of those will and some of those won't. But bringing it back to our industry, there is a lot of hope money trading hands, no question about that. People have to deliver, they have to perform, and if they do, then they get well remunerated. If they don't, well, then they find another job that's maybe 30% less money than what they're earning now. But certainly the hunt for high quality people with a proven track record who are going to be able to deliver for a business over a 10-year period, it's a very tough market to be trying to fish in at the moment. There aren't enough fish, there's too many fishing.
Yeah, no, I think, very, very good points made. So, Chris, as you're aware, very much aware, our conference is later this week, our flagship conference. It's centred around navigating a bright future, in which, DRS Bonds, MGA are our headline sponsor, and thank you very much for that.
Pleasure.
So again, just an open question. What do you think, given what we've discussed, what do you think are the key components of a bright future over the next 18 to 24 months?
I think it's dynamism and flexibility, Mike. I think that there has to be an improvement program that looks like, just because we've always done X this way doesn't mean we always have to do X this way. And there is still an awful lot, dare I say it, because I'm pale, male and stale myself, hopefully not stale, but there is still a lack of diversity in terms of top table. I would love to see many more people from diverse backgrounds with serious credibility coming to the fore and really challenging the industry to change and evolve and develop. And what does that look like? It means sometimes thinking the unthinkable, or thinking things that historically, just weren't possible. I think there's lots of new market opportunities. If I look at our own marketplace, with the changes to banking regulations, for example, there's an opportunity to use surety bonds as quasi-bank guarantees for investment grade businesses and those there and thereabouts, which historically brokers have played at but not been that successful at. So there's an opportunity. And I think it really, the innovation piece is what it's all about. I don't mean you have to reinvent the wheel, but to an extent, just doing something better than everybody else may not be enough anymore. I think it's about coming to market with a fresh approach, fresh ideas, old-fashioned values, high-quality service, the very best professional advice, absolutely. But just looking at things a different way rather than looking them through the same glass that they've always been looked through.
Yeah, again, great points, and let's hope sort of, the wider sector creates the right environment for that to sort of, flourish and come through. Absolutely right. Okay, so finally, hopefully in 12 months' time, when we sort of revisit and have another sort of conversation again, what would you be hoping to share with me around sort of progress and, certainly linked to DRS Bonds MGA?
I very much hope that we've got our capacity providers in place. The first one we're hoping will be an MGAA member, of course, will be in situ before the 1st of October. And then the plan would be that 2 further providers would come on stream Q1 of 2026 and Q2 of 2026 to complete the panel of 3 that we're looking to feed in terms of MGA business. I would like to think that the underlying DRS bond management business has had a stable year. And, to be honest, Mike, I hope things are relatively predictable, dare I say boring. But certainly we don't expect to be shooting the lights out over the next 12 months, but we're preparing the ground for the following 2 years to that, where we really look for the business to not grow vertically, but to have controlled and measured growth alongside our MGA partners.
Absolutely. Well, Chris, knowing you, your team and your business, I have every confidence that you'll be ticking all of those boxes, and it won't be boring at all. So, Chris, let me thank you very much again on behalf of sort of MGAA and MGAA Conversations for sort of taking the time to talk to us and enlighten us around your extremely sort of niche area of business. And I look forward to catching up with you very soon. Thanks very much again for your time. Many thanks for listening. We welcome all feedback, so please get in touch with your suggestions on topics and future guests. Please don't forget to subscribe on your chosen platform so that you don't miss out.